Hey there. I've had a couple of questions come in this morning about recent market volatility and some of the headlines that are out there. So I wanted to send you a quick update so you could see what I'm watching, what I'm paying attention to, and most importantly, what you should be paying attention to as well, or what you should know. So there's a couple things moving the markets, and here's a quick run through of those. First, over the past couple of weeks, there's been a rotation that traders have made out of high growth assets, which is where most of the money has been, or most of the market participation has been over the past 2 years. And some of that money is flowing out of growth and it's going into other assets, such as value stocks and bonds and utilities and small caps. And the reason why that's happening is because traders are sensing that higher growth is slowing down a little bit, so they're moving into other assets that traditionally will do a little bit better when rates are coming down, which leads me to point two, the Fed. We've been talking about the Fed for several years now, and they did not cut rates in July. I felt that they probably should have. I'm 100% confident at this point that they will cut rates in September. And the reason why I'm more confident is because of number three. On Friday, we got the jobs report, which showed that less jobs were added in the economy than forecast. What that did is it took the unemployment rate up from 4.1% to 4.3%. And remember, that's part of the Fed's dual mandate, right? They have to keep prices stable. They've been working on curbing inflation for the past couple of years, and they have to keep a steady unemployment rate, or I should say, steady employment rate. And what we're seeing now is inflation has come down. It's within the target range that the Fed set. We're seeing unemployment go up, also within the target range that the Fed set. And so we should feel pretty good about the fact that they're going to cut rates in September. Another reason why I'm fairly confident is number four. We had our ISM manufacturing index update come out last week around Wednesday, and that showed that manufacturing output is slowing as well. And actually, that's been the case for most of this year. This month's data is just confirmation of where we are in the cycle and what the Fed really should be doing. Number five, this one's a little bit outside of norm, I should say, but overnight we saw the Japanese market, the Nikkei index, down sharply because of what's called the yen carry trade is unwinding. So real simple. What this means is that traders have been going in, they've been borrowing yen at very low interest rates. They've been taking that money, they've been buying higher yielding assets, and they get an arbitrage on that money. And so the Bank of Japan is considering raising their rates. And if we have global markets slowing, that trade will not be as profitable. And so money is moving into other places. Traders are seeking safer assets. And so that's what we've seen there. That rippled through the economic markets, the financial markets globally, including our own. And then number six, this also happened over the weekend. We saw some increased tensions between Iran and Israel and Lebanon. And so that's creating some uncertainty. There was a note in one of the research reports that I get every morning, and this morning's note particularly stood out to me. I wanted to read it to you real quick, and I quote, "Last week's data just told us unequivocally that growth is slowing and the market finally had to listen. That does not mean a contraction or recession is imminent. And as such, we do not think de-risking your portfolio via raising cash is appropriate unless you are sure you can get back in appropriately because the outlook for this market hasn't significantly changed as much as the price action implies." So what that means is that prices are down. The headlines this morning say that recession fears are imminent, but I don't think that's the case. I do think that we are seeing some slowing, and that's where we are in the cycle. So, what should we do? That's the big question, right? Well, as of right now, we're going to stay the course, but not complacently. If you remember last fall, I added a couple of investments to the core portfolio that are built to hedge volatility. And so far, they're working. And so, even though our account balances are down a little bit, we're not down as much as the rest of the market is. And so that's exactly what a diversified portfolio is intended to do. Here's the other thing I wanted to show you real quick, which is why there's a chart on the screen. This actually feels very familiar for what typically happens in the markets July, August, and September, and sometimes even into October. So I thought I'd show you real quick, just so you can kind of see that this is sort of the normal rhythm of the market. So this is July of this year up to today. We see the decline coming into August. If I take this back to 2023, let me take this to October of 2023. Here's the decline coming into August. If I go back to 2022, that was, remember, a bad year. Here's the decline through August into September. Remember, the market bottomed in October of 2022, and then we had a great 2023 and beyond. If I go back to 2021 year, kind of pandemic recovery, here we see a decline in July, and then we see another one going through September. If I go back to 2020, which is the full pandemic year, we do see a decline going through September. If I go back to 2019, which seems like forever ago at this point, here's a sharp decline through August with a lot of volatility. If I go back to 2018, I think you're getting the point. A little bit of volatility here. Price has kind of stabilized a bit and moved upward direction. If I go to 2017, we've got quite a bit of volatility here in August with a bit of an increase in September. If I go to 2016, we had a decline through July, and then prices stabilized with a little bit of volatility in September. If I go back to 2015, I remember this one really well. China devalued the yuan. And here we go through August, fairly sharp decline. 2014, right, we can keep going. This is just how the market behaves this time of year, and it happens for a lot of reasons. It always seems like there's a lot going on, but here we are. So I want you to know that I'm watching this closely. Yes, this feels familiar, but I don't want to, like I said, I don't want to be complacent. And I also don't want to just kind of pat you on the head and tell you everything's going to be fine. I'm watching it. I'm reading a lot of research. I'm happy to pass that on to you. And if you have questions about your portfolio, your financial plan, or how all of this plays into what you're looking at for your future, please reach out. Always send me a text, a phone call, an email, and I'm happy to talk with you. And we will be talking this fall and checking in on the portfolios and doing all the things we normally do. So until then, I hope that you're enjoying the end of summer. Reach out if I can be helpful, and I look forward to talking to you soon. See ya.